Okay, this is just a rundown of Warren Buffett and financial independence, how the two relate to one another, and this is Building a Small Business That Warren Buffett Would Love, published by John Wiley and Sons, and it's available on Amazon and Barnes and Noble. And it details the Warren Buffett framework and how that relates to small business. Um, but here's an overview of the Warren Buffett fundamentals as found in the book. And essentially he invests from a business perspective, which means he sees himself as a part owner in the business and not just a stock investor betting on the ups and downs of the short-term market. He looks for a consumer monopoly or a toll bridge, and what this means is, take Coca-Cola for example. It would be very hard to replicate the brand that they've built up over 100 years. They have that brand that's really embedded in the minds and hearts of consumers. A toll bridge would be that it's the only game in town, like the only movie theater in a town, where if people want to see a movie, they have to go to that establishment. On point 3, strong, consistent, growing earnings. If I had a chart of Coke's earnings here, year over year, just earnings per share, you'd see a steady trend, which is typically upward and growing. So it's a steady upward moving trend of earnings per share. Some years, every now and then they might have a blip on the radar screen, but the overall trend is upward moving, versus a company that's quote unquote more of a commodity type business. You would see more erratic behavior in their earnings. There's not a trend there. High return on equity. This is the return received in the business. And back to earnings, Warren Buffett considers the earnings his. If he owns 100 shares and it makes $1 per share, then he considers that he's made $100. And the return is the return that they're producing on that equity in the business. So if there's evidence they're able to generate high returns and management's doing something right consistently over time. And to the next point, if they have the ability to reinvest those earnings, and that's even better, because now we've seen evidence that they're able to consistently grow earnings and generate a high return on it, and they're able to continue to reinvest it back into the company. So in the Warren Buffett world, he doesn't necessarily want the money distributed to him through a dividend, because, hey, here's the fountain of gold right here with this company, and they're able to reinvest it back into high returning investments. That's perfect, because if you distribute it, now I have to do something with it. If you send me $1, I have to go find a new investment that's as great as this one that we found, or I can go spend it on donuts. Keeping up with inflation, that's one of the beauties of a consumer monopoly company that maybe like Disney, for instance. I think ticket to Disney World back in the 60s cost about $3 or $4 to get in, and now you're talking I think it's about $50 to $60 for a day pass. So what that means is they're able to raise prices on that as some other expenses may stay the same, and they can benefit by that. Low levels of long-term debt. This really serves two purposes. If the debt levels are low, that means that cash flow, in Warren Buffett's opinion, is strong. It's a strong cash flowing business that doesn't necessarily need a lot of large debt levels to fund its operations or its investments. It's also a sign of lower risk, because obviously they're not at threat of not being able to pay the bills, is one way of looking at it. And the last point is gross and net margins, which is kind of, if you're familiar with the income statement, it's kind of the duh factor, but really, when you get down to the net, a business that's not completely gutted out by high cost of goods sold, has the potential obviously to pass more down to the bottom line, and a healthy gross margin indicates they're able to manage their operations well. Now, how does this relate to financial independence? If you've read Rich Dad Poor Dad, this picture is familiar to you. You're going to see basically financial statements represented here in more of a pictorial fashion. You've got an income statement on the top and a balance sheet on the bottom, and of course the Rich Dad mantra is to invest in assets that can feed cash flow into your income column, and once you have enough passive cash flowing assets that meet or exceed your expenses, then you're financially independent. And that's what this next slide shows. So we have, say we have rental property here, maybe a fourplex, we have dividend paying stocks, we have Buffett style stocks, maybe you own a car wash, and that delivers, and let's say we have monthly expenses of $3,000 a month, and these generate $3,000 a month in cash flow. That'd be net cash flow, right? So once that point is met, that's a critical mass point, and technically we are financially independent. And that's just a good goal to have. And I always say this about it. I really appreciate the independence part. It's not so much to have gold coins to roll around in like Scrooge McDuck. It's more security, it's more independence, it's more option, chiefly. So the question becomes, where does the Warren Buffett paradigm fit into it? Well, obviously down in the asset column, because if you're making a stock investment, even from the purely capital gains side of things, if you're looking for Coke stock to appreciate, by 10% a year for the next 10 years, then it would fit in this asset column, and I would argue that that steady capital gains increase can be considered cash flow, because you can cash it out. There's going to be some tax consequences to that, but typically in the Robert Kiyosaki paradigm is that no, don't invest for capital gains. You wouldn't flip a property because of the taxes that you'll get hit on, and plus he wants to make the analysis up front on, say, a rental property and make the investment once and then have it deliver cash flow for years and years to come, if not forever. But he does agree with Buffett style investing. He's written about it in his books. So Buffettologist, or somebody that invests like Warren Buffett, is essentially doing the analysis up front on a good business, not a stock that's either up or down. That person is selecting a good consumer monopoly with a durable competitive advantage with that track record of earnings, high return on equity, the ability to reinvest those earnings, the ability to keep up with inflation and low levels of debt. And that, my friends, is a good sustainable cash flowing business. You purchase it here, and then the cash flow can come from the dividends of it or the capital gains that you would have to cash out. But since it is a stalwart investment, then the paradigms meet as far as I'm concerned, and the capital gains from a Buffett style investment can be considered cash flow that lead to financial independence. And this just continues the overview of the Rich Dad Poor Dad paradigm, where if you want to be financially independent, you need to get here, but different classes spend their money differently. So some folks, income comes in, but then expenses come right out the door. That could be the food and grocery bill, eating out costs or entertainment would fit in here. Middle class will go get ski boats and cars and mortgage debt, and that would feed the expense column. Then so their income comes in, heads out the door before it can reach the asset column. This is labeled the rich, but I would say again, financial independence to me is a completely different definition than being snobbily rich. And they take their income and invest here first. And as it relates to the Warren Buffett paradigm, this would be Buffettology in a nutshell, and identifying those companies, or as Buffett prescribes, if you don't have the time to read company reports, the annual reports and the 10Ks and the 10Qs, and do extensive research and follow his methodology, then a good index fund would fit here as well. And what are the definitions and examples of other assets? Well, here's the definition again. It puts money in your pocket. You reach financial independence when you've met your monthly expenses through this cash flow. Let me just back up 1 second. You can also see that the lower your expense column is, the faster you can probably reach it. So it's kind of augmenting the means and diminishing the wants. So the same here with the liabilities. So probably a good plan to follow would be the Dave Ramsey plan. Is he's got, I believe it's 6 or 7 baby steps which really help to manage the expenses, and those are $1,000 emergency fund, pay off all your debt, smallest to largest, pay off your house, begin 401k mutual fund investing, which that would start here, establish a 3 to 6 month emergency fund, and then go on to advanced investing and college savings for the kids. So you can see that a lot of his plan, the paying off the debt part, that would really attack this. So and the liabilities column. So as far as diminishing the wants, you might start off with expenses of $2,000 or $3,000 a month, but if you manage this right, perhaps get it down to $2,000 a month, and now you only have to generate $2,000 a month in cash flow in order to be financially independent. So, and then so what are the assets? Well, we already defined Rich Dad, Poor Dad, the Robert Kiyosaki paradigm. He doesn't necessarily like mutual funds, but he does agree on Buffettology. So you can place the Buffett style of investing and cashing out capital gains as cash flow if you had to in that asset column. Now, Warren Buffett says, why would I do that? It's a great investment. I want them to keep reinvesting it in the company. I don't want to cash out. I want to hold it rather than reinvest it. He doesn't necessarily have a lot of material ones. He has more fun seeing the snowball grow. That's what he would purchase. If he had the cash, would be more snow to pack on the snowball. So he leaves it in there, and there's no tax consequences when those earnings are reinvested, and when he doesn't cash out capital gains. So he continues to let that grow. But if you're over here and you're Robert Kiyosaki guru and you wanted cash flow, then technically that cash flow would be that capital gains that you could cash out on a reoccurring basis. But his typical examples also include cash flowing rental properties such as duplex or fourplexes, I guess even a single family home, dividend paying stocks, because again they would pay quarterly, and we almost get down to a mindset of checks in the mail. So certainly they pay out a dividend. Again, Buffett would typically want that reinvested. Covered call options are another thing we'll look at, but again, if it starts to run counter of Buffettology, then it's something to look out for, because I think Buffettology trumps covered call options, and so empirically we want to preserve that first. A business system. When it gets down to business, you can check out the book Building a Small Business. Warren Buffett would love, but most people start a business. I would probably argue that they start a business to have a job and not as an investment. So from our paradigm of Warren Buffett, we want to own some of the greatest companies in the world, such as Coca-Cola. So I want to be an owner of that business and treat it as an investment. So I guess my conflict with starting a business is if I need a job, in a lot of ways it's more prudent to go get a job, because there's a lot of security there. If I want to own something great, why would I would want to own Coca-Cola instead of Adam's hamburger stand. Just turning off the lights doing that. But if you truly want to, then I say you truly want to model the fundamentals of what Warren Buffett is looking for, and therefore I say check out the book Building a Small Business, and Warren Buffett above. This gets into tax consequences of the Rich Dad, Poor Dad. I don't think I'm necessarily going to go into it, but the bottom line is the tax rates for receiving a paycheck are much higher than if you receive portfolio income and passive income chiefly through rental property, this can be lowered down pretty low. And that's important. And a business in that whole tax framework, business spends first and then pays taxes secondly. Another thing too is just having a good goal setting framework, and this kind of lays that out of, write out specific goals. If you wanted to purchase a duplex by September 22nd 2013, then be specific about it. Read through it a few times a day and rewrite it a couple of times, and then ask this question: what has to happen in the end of 3 years in order to be satisfied with your progress? And that's and again, kind of whole paradigm is joining Warren Buffett with financial independence. And again, Warren Buffett is a part business owner, if not a whole business owner, in some of the greatest economically superior businesses in the world. And so what those land here in the asset column within the rich dad framework, and in theory they can deliver the cash flow to lead to financial independence through capital gains and dividends. And once your cash flow is equal to or greater than your monthly expenses, and you reach financial independence, which allows for more options, provides greater security in the event of a personal catastrophe, personal economic catastrophe. And then thirdly, perhaps it leads to more toys, if you want to head that direction. And this is, in my opinion, the fundamental library to achieve all this. Buffettology is a breakdown. Now, this is his former daughter-in-law. This was an investment analyst that used to work with him. But at the end of the day, this is their book that they claim captures Warren Buffett's methods for investing. But again, they're trying to sell a book, so you have to read it and decide for yourself if this truly captures it, or do some more research. This is my book, Building a Small Business, that Warren Buffett would love, which basically provides a mapping of the Warren Buffett fundamentals to small business. If you're going to go the route of building a business, I recommend this. Rich Dad Poor Dad presents the framework of financial independence, and those pictures of the income statement and balance sheet that we saw previously. Dave Ramsey's Financial Peace will provide that. I would say one of the most solid personal financial plans. I think he gets it 99% correct with that. The Millionaire Next Door explains there's a lot of statistical research on basically how people save money and accumulate wealth. And then goal setting techniques would be the Success Principles by Jack Canfield. That's it. That is the overview of how Warren Buffett's methodology maps over to financial independence. And I think I'll probably post another one that'll show more of those track records of earnings from Coke and other consumer monopoly companies. So thanks so much.